Well, you guys asked for that. My favorite value stock right now with some proper growth attached to it too. A true super stonk, if you will. Now let's get into it. Financials. We will now dive into, in my opinion, most important metrics of this company. After which I'll grab my emergency Uno reverse card and you'll have to decide for yourself if the company has a moat. Deal? Deal. I have extracted all these numbers from the company's 10Qs and 10Ks, so they should all be completely correct, but honestly I could have put any numbers here and you would have believed me anyways. First, ROE and ROIC. ROE stands for return on equity, and basically this number tells us how efficient a company is using its own equity, or assets and liabilities combined, to generate net income. ROIC then stands for return on invested capital, and basically this number tells us how efficient a company is getting a return on its invested cash. Both metrics are extremely important to determine if a company has a competitive advantage, if it truly has a moat to keep the competition away. And this company without 2011 would have an average well above 10 for both these metrics, which I would say showing us a lot of strength in their pricing power, in their investment abilities, but especially in their financial efficiency. Next up, growth rates. I believe a great company should be growing over time, and the first metric we'll look at is book value per share, or how much the company is worth on paper. Second, earnings per share or net income per share. This should tell us about the ever increasing profitability of the business. Third, free cash flow per share. This is another metric of profitability, but this one should tell us about how much actual cash flows the company is getting per year. And lastly, revenue growth. If all these numbers are going up over time, well then the company is truly growing. If only one or two of these numbers are going up over time, well maybe then something else is going on. Maybe the company isn't really growing as fast as we would like. Well, this bad boy of a stock has been growing at insane amounts for a long ass time. Here we can see the raw numbers, and here we can see the growth rates per each metric. First, book value per share. We've seen an average growth rate of 37% compounded for the last decade, which only slowed down to 28% for the last year. Certainly solid. Second, EPS or earnings per share growth, 62% for the last 10 years, which is just mind-boggling, and it even accelerated to 100% growth in the last year. Truly insane. Free cash flow per share, a 49% growth in the last 10 years, and an even more mind-boggling 174% growth in the last year. And lastly, revenue growth, 38% for the last decade, with a 62% growth for the last year. These are all truly insane figures. And their debt levels are actually really low too. They currently have about $2 billion of debt outstanding, but they earn about $7 billion of net income per year, meaning they can cover all their debt in just 0.3 years of net income if they would like. What's more, the company has actually been doing share buybacks, as we can see from this chart where we're looking at shares outstanding, and for the last couple of years these shares have actually been decreasing, hinting at share buybacks from the company. And from recent news reports and history of this company, it seems the share buybacks will only start increasing from here. Quickly, for those of you that don't know, when a company buys back its own shares, the shares outstanding goes down. And because that goes down, because there are less shares trading in the world, the percentage you own of the business increases over time. So share buybacks are a really efficient way to give back to shareholders. Back to the financials of the business. Over time, their gross margins have been stabilizing well above the 80% mark, which is really solid in my opinion. And their net margins, their net income margins have been steadily increasing over time and are now at a whopping 51%. These last two metrics mainly tells us that this company is extremely good at turning new revenues into profits, which is certainly a good trait to have. So those are the financials. What do you think? Do you like the company from this purely financial view? I certainly do. So I believe it's now time for a company overview. And the company we were talking about has been Regeneron Pharmaceuticals, or ticker symbol REGN, all along. Currently, the company produces 7 drugs and treatments, as well as their COVID-19 treatment, which is emergency use only. Revenue-wise, the company is quite reliant on Eylea and Dupixent, which could be a risk, but the company is constantly looking to diversify with currently 40 drugs and treatments in FDA approval trials. And if just 1 or 2 of these hit big, it could significantly alter the business revenue streams. So that is a quick overview of the company. Of course, if you would like to invest in this business, you would have to do a way deeper dive. always do your own research. But now I want to focus on the value proposition. Remember Regeneron's insane EPS growth, the 62% average growth rate for the last 10 years, which actually accelerated to a 100% growth rate the last year? Well, if we just extrapolate that growth rate into the future, the company should be worth about 100 times as much today as it is now. But of course, another 10 years of 100% growth is extremely unlikely, so what if Regeneron were to grow their EPS at 20% for the next 5 years and 10% after that? Well, I have taken the most recent trailing 12-month EPS, so the starting point is actually Q3 2021. But this growth shown right here results in an EPS of $265 per share in the year 2031, which seems like a lot, but is actually about a 4x in EPS in 10 years. Keep in mind, Regeneron did a 20x in EPS in the last decade. If we slap on a P ratio of 20 in the year 2031, which I do not think is outrageous for a company with these financials and growth rates, then we might see 265 times 20 results in a share price of $5.3 thousand in the year 2031, which is just shy of a 10x return in 10 years. If we discount this number at 15% per year, which is my opportunity cost, we get to a value of $1,300 per share today. Meaning, assuming zero risk, I should be willing to pay $1,300 per share for Regeneron. But as with any company, there is a little bit of risk. Not a lot, since Regeneron is an absolute chat of a company, but they could make some bad investments, for example. To mitigate a lot of this risk, we actually apply a margin of safety. And at the current share price, we're able to apply a margin of safety of 50%, which puts us at roughly $650 per share as my personal buy target. Anything below this figure I believe to be a steal. My opinions. So there's that. $650 per share to buy Regeneron with outstanding financials, plenty of growth and a great management team. I told you, a true super stonk. But even without any growth, the company is still only trading at a P ratio of 10. Meaning if the company just stopped growing today and became a cash cow now, it would still generate you a whopping 10% per year. Of course, these are all just my opinions. You do need to do your own research. Do not just buy a stock because I told you so. This is not an ape together strong stock. Also, this video actually has picture perfect timing since we are expecting Regeneron's Q4 earnings on the 4th of February in just a couple of days. Before the last earnings date, we had basically a guaranteed earnings beat, and of course I made a video back then too. And to pat myself on the back, I was absolutely correct on my call that Regeneron would beat the Wall Street estimation. This time however, Wall Street has leveled up and they are more aware of the fact that Regeneron has REGEN-COV, which is the emergency use drug of Regeneron, and it has an insane earnings power. The street is expecting an EPS of almost 19, which I believe to be a little bit high, but we have seen an insane $28 EPS in Q2 2021, so it is certainly possible. What I'm trying to say is, I do not believe we have a guaranteed earnings beat this time around. However, I believe whether Regeneron actually beats the earnings estimation doesn't really matter. If they beat the estimation, I am once again reaffirmed I'm holding a gem of a company with a chef's kiss level competitive advantage. If the earnings come in slightly below the high mark set by Wall Street, well, then Regeneron is still right on track to destroy the price target calculations we've just completed. And if the management drops the ball and we do get a lowball $2 EPS for the quarter, well, then this video will at least be a part of the next top 10 anime betrayal list, which I would count as a win too. Also, thanks to anyone voting on my community tab, you've made this video happen. I really enjoy catering videos to what you actually want me to produce, so there is another poll live right now. Go check it out and cast your vote. With that said, I really hope you guys enjoyed this video, and if you did, please give it a like and maybe even subscribe. Comment down below what you want to talk about next, and I'll see you guys in the next one. Peace.